Hello and welcome to Focus IR. I am John Human. I'm very pleased to be joined today by Jacques Vaillancourt, President and CEO of Mineral and Financial Investments. How are you doing, Jacques?
Well, thank you, John. How are you?
Very well, thank you. Very well. So thank you for joining us today. What we're really going to be doing is helping our viewers understand mineral and financial investments, what it does, a little bit about its history, and the people behind it, including yourself. Perhaps you could kick us off by introducing the company.
Well, thank you. Mineral Financial is an investment company that I bought control of about 10 years ago. It's Cayman-based, and we cleaned it up. And the objective of Mineral Financial is essentially, if you had to describe its investment style, it's like that of a venture capital fund. And I always thought there was a degree of license because there's always a degree of required humility in this sector, but in many ways, we're very, very similar. I was surprised to find out that the average size of the average VC fund in the U.S. is about $35 million. We're about 15 U.S., so we're not a million miles away. Our performance has been better than by quite a long ways to most VC and private equity funds over the last 1, 3, 5, and 10 years. So in many ways, that's sort of our style. We are slightly different in that we can have as much cash as we want. We have a great deal of flexibility. And the way I try and describe it to people is our difference is that we have permanent capital, but our investors have a degree of liquidity they can exit. Whereas if you're in a VC fund, you're locked in for either 5 plus 2 years or 7 plus 2 years, or maybe the 9 plus 2 years. So you have zero liquidity. The additional advantage of how we're structured is that we're publicly listed, which gives you liquidity, but there are times when we trade at a discount. And we've been trading at a discount for a while because we're fairly small and we're in a fairly unfashionable sector. So when you're buying a dollar's worth or a pound worth of assets with us, you're paying 60 cents, which irritates me to no end. But and we have traded at a premium, and I expect we will trade at a premium again in the future. So. But our style is more akin to that of a venture capital, but we have much more flexibility. And if you want to continue on why I sort of came up with this structure, I can.
Absolutely. I mean, it's very, very similar to the investment company structure, the investment trust structure.
Well, we are technically, but our investment style is like a VC. And to give you a bit of background, I was an analyst at the biggest Canadian investment bank. Then I was head of equities outside of the Americas for another Canadian investment bank that was sort of number 2 or 3 in space, but number 1 in the world in mining. And then I was global head of metals and mining for a global bank. So there's a lot of focus in the mining space over a 30-odd year career. But what had become obvious to me is that the financing of the industry was always done through mostly institutional money. And most institutional money is rented, and most of the institutional money, when the market is going well and there's lots of capital available for the mining industry, and so it goes too high. And at the moment, we're at the inverse of that, where the funds that are specialized and you traditionally fund or the mining sector aren't there. And so it's magnified the cycle downwards. And so it created a bit of an opportunity for me. So if you could have a company or an entity that could invest when others couldn't or wouldn't, and if you could have a fund that could sell when others can't or won't, you should be able to outperform. And the idea on paper made sense, and the reality is that we have outperformed virtually any one of our yardsticks over the last 10 years.
Yeah, and I guess a lot of that outperformance comes down to the investments that you choose. Tell us a bit about the portfolio. Where has this approach taken you?
It always does, you're right. we focus on the natural resource space, but more specifically on the mining space. But we're not limited to that. But it represents certainly 90% of our investments. We have three types of portfolios internally. Our tactical portfolio, which can be anything from 20 to 60% of our total assets, is currently 35%, of which there's an 11.5% that's gold bullion. Our strategic portfolio is 64% of our total assets, and cash is 1.2%. And cash is abnormally low because we have a lot of bullion. And we've been accumulating bullion since, I would say, last April. And so that's proven to be a very good investment for us. We've been buying as low as at 1750. So we're in a good position. The other way to break down how we can be looked at is that, again, we're still about 1.2% cash, but precious metals are about 54% of our net asset value, which includes 11.5% bullion of that in bullion. Base metals are about 36%, and food and energy are 9.2%. It's food, energy, and technology. And the technology companies are focused in the mining space. And that represents 9.2%.
Perhaps give us a feel for the sort of trends within the market that are driving your investment selection. And bullion is a very interesting one given where we are with sort of inflationary and interest rate cycle.
Yeah. Well, the trends, I can discuss them, but listener beware. There are the overriding theme in the mining industry has been that it's been undercapitalized. It's underperformed. It's undercapitalized, and it's been undercapitalized by the funds that have underperformed, as I said before. But within the universe, there are still some great opportunities. We consciously invested in fewer investments that had higher risks in the first few years of when we created Mineral Financial, and now we have generally somewhere between 20 and 35 investments at any given point, the majority of which is in our strategic investments. So in terms of the outlook, as I said, the industry has been undercapitalized. We've focused on assets that have resources that are moving towards production. We focused on some technology companies that will allow for more efficient exploration. And we've also, because the industry is hungry for new capital, we've also made sure that when we invest, the companies we invest in are very ESG compliant. They're forethoughtful about their environmental, social, and governance requirements. But additionally, we've invested in a company that does ESG auditing for specializing in the mining space, which helps us ensure that we invest correctly. In terms of the other trends, I think the secondary one that I think will guide the markets is that I think inflation is probably going to remain moderate, but some of the interest rates are probably not going to come down as much as people expect. There are a variety of reasons, not the least of which is that the Fed is still unwinding a lot of liquidity instruments that it put out there. The second thing is the market likes stability, and the new administration in the United States is like, I think we can kindly describe them as iconoclastic and unpredictable, and that results in higher costs. And if you don't pay more for that, the U.S. dollar will come down. And lastly, the new administration seems to be an advocate of cryptocurrencies, which any other economy, I would say, well, probably makes some sense. But when you have the leading currency, everyone's reserve currency, to advocate alternatives to your currency seems ill-considered. So I suspect the U.S. dollar will weaken from its current heights. and that will help commodity prices broadly.
How much does the energy transition, the ongoing energy transition, sort of play into your thinking about where you invest?
Well, it has to play a role in everyone's thinking, but we missed the first lithium run up like completely, and I refused to participate in sort of the running it down and then realizing I would end up underperforming. So we took a pass. We focused on the investments that we did understand. And bear in mind, lithium, there's a spot market in China, and it peaked at 600,000 renminbis, and it's now 75,500. So it's down 87% from its peaks. So I think giving lithium a swerve when we did, we missed the run up, but we also missed the crash. We are now currently investing in lithium producers. And we have some positions in Sigma. We have some positions in a little company called Azimut that has some of the richest lithium discoveries in North America. So we're present there. I do have some broader apprehensions about the electrification of the world, because we talk about it with great liberty, but we haven't invested in an overall expansion of electrical capacity. Over the last 5 years, electrical generating capacity in the United States, as an example, has come down. And you go, well, that sort of runs counter to the common belief that somehow will be led by this growing electrical generation capability. So there will be some pinch points, and so we're watching that with a degree of. We have to participate. We recognize that there are ways for us to make money in and around that. But I think in 2025, copper is probably going to be, it's out of favor. People seem to think that copper is going to be an oversupply. I don't see that. And so we're going to be increasing our positions in copper notably.
Yeah, makes a lot of sense. I mean, it's interesting you mentioned that sort of boom and bust in the lithium price, because that sort of speaks to the sort of risks that are inherent within the sector, and the sort of the fact that it's prone to these sort of bubbles from time to time. How do you? I mean, you've alluded to how you manage the risk, but perhaps talk us a bit more through your approach to risk management in this often volatile space.
Well, if we were a larger entity, we might want to look at hedging ourselves and managing our risks on a line-by-line basis. But we don't. What we do is getting back to, we have cash, tactical, strategic, because we traditionally have 10 to 20% cash normally. And if you take our gold position and market to market, we're at 15, 20% cash. So we're where we should be. And we use our tactical portfolio as a way of hedging ourselves, in that we will go long short the market, we'll go long short volatility, we'll go long short different commodities, including energy commodities. And the idea is to create excess returns from our tactical portfolio, and our long-term portfolio, which is what we call our strategic portfolio. We recognize is going to be there for 2 to 5 years, and 2025 is going to be a year where we're going to start monetizing some of our strategic investments. I can see at least 2 being monetized this year, and perhaps 3. And so by the end of the year, we could be in a position where we have a very different looking portfolio that would be very potentially cash rich. The temptation is to sit on cash, but I think we would be missing out on some interesting opportunities in base and specialty metal space. So I think the composition of the portfolio by December 31st, 2025 will be quite different than it is today.
I guess you're not going to tell us exactly what your plans are. You've got to keep some of those secrets to yourself for the time being, in a very competitive space. But perhaps as you realise that capital and redeploy, give us perhaps a feel for where that might go.
Well, as I said, copper is out of favor. We do have. I think there's graphite might be another area that is coming to the fore. And we do have a project and some investments in vanadium. And as it turns out, one of our large strategic investments, we have a 20% carried interest in a project called Lagoa Salgada. In reviewing some of our metallurgical work and trying to, and it's a VMS deposit, and VMS deposits are notoriously challenging from a metallurgical standpoint because it's usually not just sort of a host rock and then the mineral. It's a host rock and a variety of host rocks and a variety of base of metals. So it makes it difficult to extract it efficiently. But we're finally cracking it with Lagoa Salgada, and we're also finding we can get some vanadium out of, as well as indium and tin out of the Lagoa Salgada deposit. Tin is another one that I think people think is a commodity from the 19th century, but the reality is that without tin, you don't have a soldering material, and if you don't have soldering material, you don't have an iPhone or a computer or artificial intelligence. So tin, I think, could be an exciting one in 2025.
Yeah, it's really interesting. These all are, as you say, critical metals. These are all going to be incredibly important to the transition. I mean, that presumably puts you in a very good position. The fact that there is a scarcity of these metals that are absolutely essential to taking the world where it needs to be.
Yeah, there's a natural scarcity to some of these metals, most of them, and there's an artificial and temporary scarcity because of the underinvestment in the sector. And so I think both of those will create a rising tide for a lot of our investments going forward.
Yeah, indeed. Absolutely fascinating, and it really sounds like the portfolio is very well positioned to take advantage of the transition and other trends within the mining space as they take place. Thank you, Jacques, for speaking to us.